Welcome to FundsIndia's Facebook Live session in association with Sundaram Mutual Fund. We have with us Mr S Bharath, Head of Research and Senior Fund Manager for Equity with the Fund House. Armed with over 17 years of experience in the industry, he joined Sundaram Mutual Fund in 2004 as a research analyst and moved into active fund management in 2012. Today, Mr. Bharath is here to speak about the most talked about NFO in the industry, Sundaram Equity Fund, for which he is the fund manager. He will also be answering all your queries. So let's go ahead and learn about the fund and more from the man himself. Over to you, Mr. Bharath.
Thank you. Welcome all for this evening session. It gives me immense pleasure in talking about the Sundaram Equity Fund at this juncture. We are in interesting times in the market, and at this point of time to talk about Sundaram Equity Fund, it gives me a great pleasure in kind of engaging with you. So what's this product all about? Sundaram Equity Fund is our maiden offering under the multi-cap category. It's a product which will straddle across the large, mid, and small cap curves of the market. And this becomes more pertinent under the current market conditions, given the way we've seen volatility behave over the last 2 years. So what is the value proposition that we bring to the investors? As we've seen in the past, Sundaram as a fund house is known for its unique offerings at various points of time in the market. We've been through a series of launches over the last few years, and especially over the last year and a half, we've had unique offerings in the form of services fund and equity savings fund, which brought in a unique dimension to the way of investment in the market. And along those lines, again, this is a phase where we believe a multi-cap category could offer a value proposition in terms of risk reward with moderate volatility for an investor under the current market conditions. And talking a few words on the macro at this point of time, we've seen the macro print behave in a way that people started talking about a slowdown under the market conditions. But what we believe as a fund house is that this is a cyclical slowdown that India has experienced over the last few decades. We've seen enough instances in the past where we've seen GDP kind of take a pause in between and accelerate thanks to a fiscal or monetary intervention through various measures. At this point of time, again, we've seen a slew of measures over the last week and a half in the form of both central bank and the central government intervening under various forms, and these we believe would start percolating into ground action, and as liquidity improves, things should start picking up over the second half in terms of demand. While I delve into it in the coming few minutes, just to sum up in terms of what this product is all about, this is a multi-cap product which would invest across cap curves, across sectors, and across some of the best ideas that we as a Sundaram fund house research. In terms of Sundaram as a fund house, we have close to 15 investment team professional, researching across the large, mid, and small caps, and across products. These are replicated in terms of some of our best ideas across the portfolios. This Sundaram Equity Fund would be a vehicle which would encompass some of the best ideas that we have across cap curves. And as we've seen in the markets in the past, the best ideas needn't be only in the mid, small, or large cap. At various phases of time, we've seen various cap curves and various segments of the market fire. India, end of the day, is a country where we've seen through various sectors performing at various points of time, and one needs to have the nimbleness to straddle across these segments and cap curves. And in this aspect, the multi-cap category gives you the vehicle to move across in a very nimble manner between cap curves and various segments of the market. And from that perspective, we believe that the Sundaram Equity Fund would offer a risk reward to the investor with moderate volatility. And under the current market conditions, its suitability is actually much more optimal than what we've experienced in the past. Talking about what multi-caps could do in terms of experience for an investor, if one takes a look at the 5-year rolling return across any individual cap curves, be it large, mid, or small, we've seen the various indices as a proxy. If you look at it, we've seen large caps, mid caps, and small caps on a 5-year basis deliver around an average return of 12.5% between 2003 to 2019. But at this point of time, if you look at the positive experience for an investor, on average, an investor has seen close to a 98% positive return experience if one had held an investment for a 5-year period across a Sensex or a mid cap or a small cap or a multi-cap vehicle like a BSE 500. So from that perspective, what we are looking at is not just the risk returns, but the volatility that accompanies this phase of risk return. And from that perspective, a multi-cap category would be ideal for an investor who wants to have the equity experience, but with a volatility which he can digest. And where would this fund invest across? This fund, to start with, we have an asset allocation where close to 65 to 70% would be invested in large cap, close to 20-25% would be in the mid caps, and close to 10% in the small cap category. And this again would be spread across various buckets in the market. So one of them would be secular growth opportunities, where we talk about companies which have proven business models and where there is a clear runway for these companies to grow over the medium term at a sustainable pace. These could be ideas in the consumption space or the financial services. The fund would also invest a part of its investment in the companies which what we club under the cyclical recovery category. So economy goes through various cycles, and across these phases, you will have industries which display signs of bottoming out in terms of either supply side discipline or better demand conditions or return of pricing power. These could be companies which are either in the infrastructure, engineering, or industries like cement, or it could be companies what we call as under the rate sensitive category. So we would have these cycles playing out in favor of smooth industries at various points of time. So part of the portfolio would also like to capture these cycles through investments in such sectors. And the third would be the investments what we call under the emerging business themes. So at various points of time, we've seen new sectors emerge. A decade back, we never had a large industry like multiplexing, but thanks to the changes that we've seen in terms of the average consumer spend, a new industry called multiplexing has emerged over the last decade and a half. We will see such similar opportunities and emerge in various categories like wealth management, logistics, staffing, as well as online services, gaming. So these would be areas where companies have business models evolving, but there is an exponential growth available for such companies to go and tap. And the idea would be to position ourselves in companies which have the essential qualities which qualify under our 5S framework for stock selection. So when it comes to stock selection, again, we back ourselves in terms of investment through a filtered framework. What does that framework talk about? So we look at companies which pass a simple 5S framework, which is basically companies which have scalable business model, simple businesses, strong cash flows, a strong promoter pedigree, and sustainable competitive advantage. So companies which pass through the filters, these filters are later worked upon by the research team, and it finds its way into the portfolio depending on how the mandate of each portfolio is. And where do we buy the stocks? Again, in terms of pricing discipline, it's very important to observe a discipline in terms of when and how to accumulate stocks. End of the day, buying good businesses at a better price always goes over buying good businesses at bad prices. So using a GARP philosophy, which is nothing but buying growth at reasonable price, is a framework which we would like to kind of adhere to at all points of time. Adhering to a valuation discipline always pays off in the long run. So currently, we are in a market phase where we've seen a fair bit of correction happen from a valuation standpoint across cap curves, be it large cap, mid cap, and small cap. So these are opportune times which we've seen in the past, where any equity investor who's invested on such occasions over the long run has benefited in terms of timing his investment right. And when it comes to investing across cap curves, how do we choose that in this product? Between large cap, mid cap, and small cap, each one of them has a risk reward depending on how the economic growth is. We've seen in phases of strong economic growth, mid and small caps tend to outpace large caps given the growth rates and the base that they enjoy. And during phases of economic consolidation, we've seen large caps score over the mid and small caps. So one needs to have the exposure straddled across and at the same time be nimble enough to spot opportunities between these cap curves. And what would be the guiding principle to move between large, mid, and small? One would have a set of indicators in terms of either corporate fundamentals, macro indicators, liquidity indicators, and sentiment indicators, which one would be kind of diving deep into to figure out in terms of where the trends are at this point of time and move between cap curves accordingly. So this Sundaram Equity Fund would be ideally having a range of between 50 to 90%, 50 to 80% in case of large caps as a range. And at this point of time, we would like to start with a 65 to 70% large cap allocation. And in terms of the current market opportunities, a few minutes here in terms of what we see in terms of market opportunities. See, we've seen a phase where we had a high phase of growth in the previous 3 years, and we had structural reforms in the form of certain landmark GST reforms coming into place. And at the same time, we've also seen a lot of enabling infrastructure in the form of frameworks being put in place, like the IBC. And from a central bank perspective, we've seen close to a 110 bips cut in the repo rates thanks to a benign inflation condition over the last 8-9 months. And from a government perspective, we've been using the benefits of low commodity prices to spend across infrastructure areas, be it roads or railways or areas like ports and highways. So these have been structural changes that the economy has seen over a period of time. Now the question is, how much do we continue in terms of pace of growth driven by these? We as a country have consumption as a bedrock in terms of the India growth story. So from a consumption perspective, low rates have been an enabler all along. And the way we've seen data getting penetrated, consumer finance has actually blossomed over the last 10 years. And on the other hand, supporting consumption, we've seen infra spend from the government side, enabling job creation, which on the other hand, creates an enabler for consumption to sustain the pace of growth. So from a framework perspective, on one hand, we've seen government spend continuing in critical areas which are important for job creation. Consumption, on the other hand, is expected to continue its pace of momentum driven by a benign interest rate condition. And on the third, more important point, we've seen inflation remain fairly under control, which ensures that there isn't much squeeze on either the consumer side or from a fiscal perspective. So over the last few quarters, we've seen a couple of points, especially in sectors like auto and housing, where we've been off to a slow start compared to where probably the expectations were. Let me tell you here that these are again part of the cycles which each industry experience. We've seen similar cycles play out in the past, and a couple of interventions have helped these sectors come back in terms of growth. The two-wheeler industry, for example, on average has been growing at around 8% for the last 5 years, and it's just been one of the weakest starts that we've had the current year. But looking into the road ahead, if you were to see what are the drivers, we've had a far better monsoon than what was initially anticipated. So today, as we speak, we are almost on a normal monsoon with 1 to 2% surplus in terms of rainfall. And if one plots historical data, any year where we've had a good monsoon, the incoming year has been a much better year in terms of rural demand. And especially for this year, we had a couple of other enablers also helping rural demand. So one, we had the PM Kisan scheme launched in the month of Feb, which ensures a reasonable amount of income transfer from the central government to the various segments of the farm community. Second, we've had a far higher increase in case of MSP, and this comes exactly at a time when the farm output is expected to be far better thanks to a normal monsoon. So from a consumption perspective, I think the drivers are falling in place to sustain the momentum. And if you were to track low ticket consumption, that's been one area where we've seen the growth actually hold up despite some of the headwinds that sectors like auto has been seeing. So if one tracks some of the companies, be it in the consumer durable space or in terms of brown goods, white goods, or electricals like fans, we've seen actually the growth remain in high single digit or low double digit. Areas like restauranting and food continue to see a decent amount of same-store sales growth. Apparel retailing, we've seen a record sustenance in terms of same-store sales growth of some of the incumbent companies over the last 3 years. So it's not been a one-way street in terms of consumption. It's been actually improving trend in some of the low-ticket consumption segments. And while in case of some of the premium end areas, we've seen a pause at this point of time. Our view here is that as we see some of these enablers in terms of a better fiscal spend, an improved monsoon, and a better farm income come into play over the next few quarters, this should start reflecting in terms of the consumption pattern. So from a consumption perspective, we believe that this is a far more secular story, and in terms of some of the cyclicalities associated with segments like auto, these would be shorter term cycles which would have the tendency to come back as some of these interventions start playing it. And from a government perspective, in terms of the other measures, if you were to read through the last 1 week of measures that's been read out, in terms of liquidity for NBFCs, we've seen a host of measures actually coming into play. A few of them to recall would be the additional window of 20,000 crores by NSB to housing finance companies. We've seen the partial credit guarantee scheme, which was announced in the budget, come out in terms of fine print, where close to 1 lakh crores of retail loans from the NBFC side would be guaranteed once they get sold on to the banking sector. And we've also seen in terms of the monetary transmission starting to take effect, where we've seen so a few of the larger banks starting to announce in terms of cuts to the lending rates. So it's been a gradual process in terms of liquidity improvement, and since June, the liquidity environment is far better than probably where it's stacked up in the calendar year 2018 second half. And NBFCs, end of the day, are the wheels of the economy when it comes to last mile connectivity. And if we see a scenario where some of these requirements of liquidity are getting addressed in a very direct manner from the central government and the Reserve Bank, we are going to see that percolate into a much better growth in terms of advances as well as in terms of the overall financing book of these companies. So from a liquidity perspective and NBFC perspective, we see these measures starting to take shape in the coming quarters, and a couple of good data points from the festive would actually start turning the sentiment in terms of the overall consumption. So from an environment perspective, I would like to reiterate here that a 6.5-7% range of growth for our overall economy is still a pretty healthy number at this point of time when we compare ourselves with some of the other emerging markets. And more importantly, from an opportunity perspective, we've seen valuations come back to levels probably where the 10-year averages lie. And in case of mid and small cap, we've seen a much sharper correction. So at this point of time, to have a product like Sundaram Equity Fund, which straddles across cap curves, would be of advantage to an investor who comes in at this point of time with questions of where to park his investments in terms of a monocap investment. So instead of making an individual choice of whether it's a large cap or a mid cap or a small cap, if one is able to expose himself to a multi-cap category, and where historically the volatility has been far better in terms of experience than compared to monocap investment, I think this vehicle is ideally suited at this point of time for the current market conditions. And in terms of this portfolio structure, this will be a diverse portfolio with close to 45 to 50 stocks in terms of our holdings. And this again is to ensure that the risk is not compromised in terms of our exposure levels to a single stock. And at the same time, in terms of the orientation of the portfolio, this will have an orientation clearly towards growth ideas. We often have in this debate in terms of growth versus value in the markets, and the portfolio stance over here is clearly to have businesses in the portfolio where you have an element of scalability clearly kicking in, and where businesses could grow in terms of scale and profitability in the medium term. So that's broadly in terms of the portfolio structure. And to sum it up, the Sundaram Equity Fund is a multi-cap fund with investments and flexibility to straddle across large, mid and small cap, a diverse holding which would suit investors who would wish to ride the equity markets as a journey with moderate volatility without compromising in terms of risk return. So I'll stop here with my initial views and thoughts in terms of the Sundaram Equity Fund and the broad markets in terms of the recent measures, and we can have a Q&A on any of these aspects.
We have a few questions which have come up.
Sure.
And a person, Balaji Veeraraghavan, has asked, SEBI has given the guidelines that the expense ratio for equity funds should not be more than 2%. What would be the expense ratio for this NFO?
Yeah, so this would again be along the SEBI guidelines in terms of expense ratio. It's not going to be any different in terms of the overall expense structure for this fund.
Okay, and we have another question. There are some good past record multi-cap schemes available in the market. What is the unique feature available in this scheme?
Sure. So in terms of our experience in terms of the individual cap curve, so if you were to look at the large caps, so Select Focus, which is a concentrated fund investing across large cap, has been among the very few funds with a 3-year, 5-year and a longer track record in terms of beating its benchmark. We've been among the pioneers in terms of the mid and small cap category through our in-house research in the mid and small cap space. So what we bring here in this product is a collective research experience across large, mid and small cap in a single vehicle, which is a multi-cap Sundaram Equity Fund. So the differentiation clearly here is in terms of what we have in terms of a best of research ideas represented as a portfolio. And second, more importantly, this as a vehicle, while it has a flexibility to move between cap curves, the idea is to clearly contain risk, given that the whole proposition is to have a risk reward with moderate volatility. So we will straddle in terms of our overall cap curve allocations between 50 to 80% for large cap, and use alpha generation from the mid and small cap exposure, which would range anywhere between 30 to 35% at this point of time. So to answer your question, the differentiation is in terms of how much we're able to use and leverage our research strength and replicate it in this portfolio. And second, more importantly, in terms of containing the risk, while one has the flexibility to move between a 0%, 35% large cap to 80% large cap, the idea is to have risk far more contained over here. So it's going to be a fund which I would say will be an all-weather product from the basket of Sundaram Mutual offerings, where risk reward is very much there and the volatility experience is far more contained.
We have Dilip Raval, who has posed a question asking what will be the percentage of allocation in each of the large cap, mid and small cap.
Okay, so large caps at this point of time, we are looking to have investment exposure of close to 65 to 70%, and in case of mid and small caps, roughly around 20 to 25% in case of mid caps, and close to 10 to 15% in case of small caps. So that's the broad range that we're looking to start with. And again, like what I said at the initial comments, this would again be contingent on some of the indicators that we keep tracking on a regular basis in terms of market dynamics. It would hinge on the macros in terms of the corporate fundamentals, in terms of sentiment, and in terms of liquidity. It will be interplay of all these variables, and one would be taking a judicious call based on how these variables move. If we are going to see a fair amount of resilience in the macro, and should the macro start turning far more robust in terms of growth rates in the near term, obviously, the asset allocation would be straddling between a 65% large cap to 30% mid cap. If macro were to take time over a period to kind of consolidate, and things would start improving with a lag of a quarter or two, so it would be probably be a 70% towards large cap, and so it will be a judicious mix in terms of how we bucket ourselves between large and mid based on the underlying variables that we look at in the economy perspective. And over here, just to again reiterate, as we read historical past in terms of such precedents, interventions have always been quite forceful in terms of changing the direct trajectory of the economy, be it 2002 to 2003, or be it 2009 to 2010, or even as late as 2013. It depends on the pace at which interventions are done and how much impact they have on the overall system. And if one goes by history, the interventions have been quite fruitful enough to ensure that the growth comes back to its previous levels, and that will be a guiding force in terms of the overall portfolio allocation.
Okay, we have Yuvraj Subramani, who has asked, what's the expectation from this fund post 5 years?
Okay, so in terms of equities, the basic call on equities always is that it's one of those asset classes which has the ability to beat inflation over the medium term to long term. If one were to look at investor return expectations at this point of time, we've always seen that shareholders should or have been experiencing returns in terms of the portfolio returns being almost on par with what the nominal GDP growth rates have been in the past. So if one takes a 5-year average rolling return of either a Sensex or a BSE 500 since 2003, it should have been closer to the 12% mark if one looks at data as data. Obviously, this doesn't capture the alpha generation which a portfolio management team brings to the table in terms of sector selection or stock selection. These would be, again, the elements which would add on to the base number, which probably could mirror the nominal GDP growth rate. So from an investor perspective, on a 5 years, I think one has to go by in terms of the track record on what alpha generation has been done in the past in terms of the respective captains. And over here, I think being from a fundos where we've been pioneers in the mid and small cap, and we've been having a consistent large cap performance, I think the alpha generation through mid and small caps and a stable return from the large caps is what we bring to the table, and this should help in terms of delivering an alpha over and above what a typical nominal GDP growth rate would deliver.
We have a couple of questions raised on the slowdown in the auto sector. So what would you like to say about that?
See, in terms of auto sector, this is a a sector where multiple drivers are at play. So right from consumer sentiment to industry offtake in terms of capacity utilization, and which drives commercial vehicles demand on one hand, and in terms of specific segments like four-wheelers, where the number of new launches and new models are very important in terms of driving footfalls into the store. So all these become factors at play. We are in a year where we are migrating in terms of some of the energy norms. So we have a BS6 norm coming into force in the coming April. Obviously, companies are taking guard of that, and now this is going to be probably a year where the number of new models are going to be pretty muted compared to what we've experienced in the previous years. And likewise, in case of two-wheelers, we've seen the cost increases thanks to the BS6 norms now getting into play in the coming next 2 quarters, where companies would be re-looking at pricing some of the existing models on the way up, and they have to wait and take guard in terms of how the customer responds to such price increases. So it's a year of transition for auto sector as a whole, where companies are reinventing the business models in certain segments in terms of pricing, in terms of the value proposition. And this being a year of consolidation obviously means that a part of that is reflected in terms of weakness, especially in terms of the slow start that we've seen. Added to it, in 2018 second half, we've had certain cost increases in terms of insurance, as well as in terms of liquidity becoming tight, and auto as a sector has a large linkage to the liquidity available in the system in terms of consumer finance or vehicle finance in particular. So we are seeing a couple of them getting addressed now, with liquidity getting improved since last 3 months, and we've seen a fair amount of transmission starting to happen in terms of rates, and NBFCs getting a window of liquidity from both the NHB as well as in terms of the partial credit guarantee scheme. We think the liquidity roadblock would get addressed in the coming quarter, and this should start again helping the financing element come back for the auto sector. So auto, we think it could be a tale of two halves, where the first half has been pretty muted, but in terms of the incremental progress over the next 6 months, we believe that post the festive and the BS6 implementation, we should start seeing the sector come back in terms of growth rates. And as I mentioned earlier, for example, the two-wheeler sector is a sector where on average the growth rate has been 7 to 8%, and this year in the first 4 months we've been at a negative double-digit number. So the inventory correction on the base is already behind us, and at this point of time, going into the next 6 months and the year ahead, we should start seeing the sector come back as the costs get absorbed, liquidity gets improved, and a better monsoon comes into play for this sector. So if I were to break it between two-wheeler, four-wheelers, and commercial vehicles and tractors, I think two-wheelers and four-wheelers depend a lot in terms of financing and the consumer sentiment and the rural demand to come back, which we think is already under play. In terms of commercial vehicles, again, the BS6 has to get crossed in terms of milestone, and one would be able to have a better handle in terms of the growth rates once the event is behind us. At this point of time, a lot is actually harping in terms of the pre-buy which would happen before the BS6 norm comes in, which would give a kind of a leg up for the CV demand. And in terms of tractors, it is entirely dependent in terms of rural sentiment as well as financing, both of which are falling in place. So we see a better 2020 and a second half compared to where the last 6 months have been in terms of the auto sector experience.
We have Krish Reddy, who's asked about your views on the government stimulus package and its impact on the equity markets.
Okay, so in terms of government stimulus package, there have been a host of measures, one targeted at the liquidity situation, where the partial credit guarantee scheme and the liquidity window through NHB has been opened up. Second, in terms of investor confidence and investor sentiment, part of the tax measures have been rolled back, and some of the simplification processes for taxation has been put in place. Three, in terms of stimulating demand, the accelerated depreciation benefit for all vehicles purchased between now to March 20 has been introduced. And fourth, in terms of other structural measures, the government has been talking in terms of infrastructure is an area where there is a fair amount of infra spend, the fine print of which would be rolled out in the coming few weeks and months. And they've also given enough hints in terms of further measures like a proposal to introduce scrappage policy, depending on how the infrastructure is set up for that. So we have in place a fairly good response to start with. Though from a fiscal perspective, it doesn't burn much in terms of cost to stimulate through these measures. And over and above that, the recent RBI transfer, what came out yesterday, is again a boosting factor in terms of the cushion for the government to move ahead of front load some of its fiscal expenditures. So from a economy perspective, we believe that these are some of these measures are clearly targeted at pushing growth rates back to where they were probably during the early part of FY18, and we believe that coupled with this transmission of lower interest rates would also be other enablers. So from an equity perspective, we think a lot of skepticism has been priced in terms of where the valuations stack up today. So if one reads to large cap valuations, we are at close to around 16 times 1 year forward in terms of Nifty aggregate valuations. And in case of mid and small caps, it's a tad lower definitely compared to where the large caps stack up. And all these three together trade well below the 10-year averages. So there is a fair amount of skepticism priced in. And if one looks through in terms of typical indicators of skepticism, the earnings yield gap is what we look at. The differential between earnings yield and the 10-year bond yield, the gap is almost narrowed to just under 50 bips as we speak. And this kind of differentials used to be probably only on 3 or 4 occasions in the past. And every time we've had such a level, that is the earnings yield minus the bond yield, coming to levels which are almost as close to zero, we've seen the next 3 years being far more fruitful in terms of equity investments and in terms of double-digit returns. So I think we are at a point where skepticism is clearly there in terms of valuations, whereas in terms of fundamentals, we see the macro getting all those enablers to move ahead in terms of growth rate. So I think this is the typical, I would say, dilemma which an investor would experience, where the macros are pointing towards signs of improvement, whereas valuations are fairly corrected, and whether to time it or not is always a question which goes into everyone's mind. And we always also believe that it's impractical to time the market, and the best way is to get exposed in good businesses. And if you're getting them at great prices, then nothing like that. So when there is blood on the street, that's where one makes the best opportunity of it. And we are at a juncture where we've seen valuations normalize to fairly attractive levels at this point of time.
Okay, we have a couple of questions, similar questions, on how this fund compares to Mr S multi-cap fund.
Okay, so while I wouldn't be able to comment in terms of the peer group's fund allocation, the idea over here is that in terms of competition funds to this Sundaram Equity Fund, the positioning of funds are fairly different between various peers, as based on the data that we've looked at. We have seen some of our peers where the positioning has always been close to a 40% large cap, 60% mid and small caps, and there have been other end of the positioning as well, where we've seen some of the few multi-cap funds where we've seen close to 80-85% in large caps and just around 10 to 15% in mid and small caps. So the idea that what we bring to the table on Sundaram Equity Fund is to have a very balanced positioning where we don't expose ourselves to too much risk on either side, neither being too conservative in terms of hiding in large caps, nor being too aggressive in terms of mid and small caps, to have the right mix based on the market conditions and use a judicious mix to generate a risk reward with moderate volatility. So the benchmark for this product is a BSE 500, where typically if you look at a BSE 500 structure, it's got a 80% plus large cap exposure and close to 15% mid caps and 5% small caps. So this fund, at this point of time, we are starting with an investment allocation where 65 to 70% is where we would like to have large cap exposure. And in terms of mid and small caps, a 30% exposure in terms of mid caps and small caps together would take care of a reasonable amount of risk reward without exposing ourselves too much to volatility in the market. So the differentiation clearly comes in terms of the positioning that we take. And second, more importantly, I think we are coming at a time where we have the opportunity to buy businesses today at reasonable prices. So as we've done in our past equity offerings, be it Sundaram Services Fund or Equity Savings Fund, we took our time to position ourselves in the portfolio between a 4 to 5 month window, which SEBI normally allows. So over here, again, at this point of time, when the market is marked by high volatility, we believe that we could have opportunity to build the portfolio at the price points which we think is opportune enough to build the portfolio. And at the end of the day, buying at the right price is what will lead to alpha generation. So I think this window of investment available for us in terms of building the portfolio between a 3 to 6 month period, that clearly gives us the edge to have the right mix of portfolio at the right prices. So I think these are the two main differentiators. And over and above that, I think the Sundaram research experience across large, mid, and small over the last 2 decades, I think these clearly come into play in terms of what we could generate through sector and stock selection.
Ketan Parmar has asked for your views on NBCC.
I would clearly refrain in terms of commenting on stock specific, as we aren't supposed to have individual stock specific comments later in the public domain. Nevertheless, a few words on infrastructure. This infrastructure as a space, we believe that there is a clear vision under the current establishment to have infrastructure kick-started with almost close to a 7-8% what we call as a GFCF coming in terms of the spend from the government for the next 5 years. So it's a multi-year spend which is getting planned across critical sectors like railways, or in terms of some of the areas like ports and airports. So it's a much larger play from opportunity size, driven largely by government spend at this point of time. And private sector typically kickstarts when the utilization levels come back to a level of 80-85%. We are just currently under 80% at this point of time in case of RBI data. If you were to look at it, around 77-76% is where the capacity utilization stacks up from overall industry perspective. There are a few sectors like cement where the thresholds have already been hit, and a few of the companies have started embarking on capacity utilization. And from a EPC perspective, I think areas like railways are seeing massive investment plans being laid out, and in case of roads, we are seeing further plans in terms of dedicated freight corridors getting planned across some of the large metros, and where it's still at a feasibility study stage. So it's a 5-year roadmap in terms of infra spend, what we are currently getting in terms of data to be seen. And from a company's perspective, most of the companies which have survived the previous downtick in terms of infrastructure sector, these companies currently are enjoying order book to sales visibility of close to 2.5 years minimum. So there's a fair amount of work to be done from the current orders for these companies on the execution side. And over and above that, we are seeing visibility from some of these sectors like railways and dedicated freight corridors kickstarting probably a couple of years down the line. So I think it's going to be a much longer haul in terms of pure EPC as well as infra companies in terms of visibility of growth. And with respect to individual companies, I would leave it at best to your wisdom in terms of judging the capabilities of these companies and in terms of the opportunity landscape. Nevertheless, we as a host, we are positive on the overall domestic infra construct.
Naveen has asked why Sundaram Midcap Fund has lesser exposure to chemicals in comparison to benchmark and peers. Okay. Any particular reason for being heavy on services and low on chemicals?
Okay, so from chemicals as a sector, we have a blend of companies which range from commodity companies to specialty chemical companies. And obviously, one has to make a demarcation between which businesses one needs to own within the investment framework what we are adopting. So we as a host, like what I said, we have a 5S philosophy. We look at companies where there is a scalability with strong cash flows to be generated and a strong promoter pedigree. So chemical companies, we do have specific set of companies as exposure where we believe there is a longer term play in terms of these companies gaining strength based on the relationships with global innovators, and they becoming long-term partners in terms of their outsourcing requirement. And they have been seeing a fair amount of business kind of shift from the Chinese markets to our market. So we try to look at companies which are not pure commodity companies, but rather companies which have capabilities on the conversion element. So there are companies which specialize in toluene chemistry. There are companies which are into CRAMS as a space, which form a part of portfolios. That's one reason why we've restricted ourselves with companies which have less of cyclicality and more of a steady cash flow generation possible through these relationships. In terms of services, again, it's in sync with the concept that we launched in 2018 September through our services fund. So we as a host, we believe that the services economy is growing much faster than the broader economic average, which is read through a GDP print. This is again is a function of how the demographics shape up and how we see multiple new segments emerge in the services economy. This again comprises a lot of sectors which are either small today or nascent today, and which have a exponential growth ahead. So this services sector is again a function of how each and every developing economy experiences when it grows in size and stature, and which is why a few of our bets in terms of services economy has been targeted at capturing such kind of growth rates where companies are able to capture a long-term growth with a fairly a good amount of cash flow generation and balance sheet structure in place. And in case of again, be Sundaram Services Fund or Sundaram Mid Cap Fund, these bets have been taken in line with the 5S framework, where we try to pick services companies, be it in logistics space or in terms of a few of the industries like multiplexes, for example. These are areas where we've been holding on to bets for a fairly long period of time now. So, for example, in case of multiplexing, we've seen how the industry has changed dynamics the last decade or so, where the established players through M&A have taken a fair amount of leadership in consolidating the industry, and that's given them avenue to grow in terms of using their ability to price themselves on the advertisements or food and beverages. So that's broadly in terms of our call on services, where we as a house remain positive across various segments of the services economy, and we've been exposing ourselves for a long period of time in businesses where we think promoter pedigree and scalability is very much there.
Jeevan Philip has posed a question asking why, in the current scenario, when mid-caps are down, why more exposure is not aligned to them. Also, what is the average 5-year return you have visionized with this fund? Okay,
so start with a 30% exposure mid-caps is not too low. At the same time, it's neither too high. It's a balanced exposure is what we believe. And end of the day, the objective is to deliver a experience to an investor where he has alpha generation and risk reward without having the need to stomach too much of volatility. So that's the whole investment objective when it comes to this particular product. So in that perspective, we are starting with an exposure of 30-35% to mid and small caps, and this again at this point of time, the valuations are stacking in favor of large, mid, and small compared to the long-term averages. We will have to see how the growth shapes up across these cap curves in various segments of the market in the coming years. Like what I said in the previous few comments, that across various phases of market, you see different sectors and different cap curves taking leadership in terms of growth rates. If you were to recall, 2012, 13, 14 had the hallmark of the growth getting delivered largely by IT, consumer durables, FMCG, and healthcare. And then we had a phase in the following years where cyclicals were fairly resilient in terms of delivering growth rates, and financial services was one of those largest sectors where growth rates were far more higher than the overall average. So it's one needs to be judiciously balanced between cap curves and sectors in terms of trying to capture growth. So this as a vehicle, Sundaram Equity Fund would balance risk reward and growth versus the risk taken. So the exposure to mid and small caps would be far more measured and calculated. And if an investor definitely would require a higher element of risk reward, obviously, that would come in terms of exposure levels based on the indicators that we track in terms of the overall economy and growth rate. So there could be phases where one would require to be taken, one requires higher risk reward and one sees the opportunity. Obviously, one has the ability to move across the cap curve at that point of time. But under the current market conditions, where we've just started seeing some of the measures getting rolled out in the overall economic landscape, probably one has to be much more measured in terms of allocating between cap curves and going in for a complete bias towards mid and small caps at this point of time.
Okay, there's a question which asks, what's your view on the finance sector and infra sector? Which sector you will look into the period for the next 5 years?
Okay, I have covered infra in the previous comments, where I believe it's a much longer haul in terms of opportunity. Financials, again, we've seen this play out quite well in the Indian landscape. We've seen retail finance being a secular theme over the last few years, and over and above that, we've seen new business models evolve. Be it a small finance bank as a category, and within NBFCs we've seen asset financiers as well as boutique housing finance companies also take shape. So from a finance perspective, we are an underpenetrated country in terms of a lot of the pockets of segments of financial services, be it insurance or in terms of retail finance or in terms of some of the sub-segments which we see in the financial services category. These are categories which we think is still underpenetrated. To give you a color over here, if you were to look at the wealth management as a space, the AUM to GDP, what we have currently as an economy ranks nowhere closer to what some of the developed economies have seen. And if you were to see the pattern of savings today in the last 6 years, household savings overall has seen a marked decline. So we've seen household savings decline by almost 6 percentage points, and this has come predominantly in the physical savings, whereas financial savings is actually held forte in this whole period of 2012 to 2019. So what we've seen is that financial savings has been holding fort. Physical savings have been kind of coming down in the form of investments in gold or real estate, and we've seen consumption actually move up. An average, leverage of a normal consumer has actually moved up. So we are coming to a phase where credit taken by a consumer has started slowly moving up, and we are nowhere closer to some of the averages which the developed economies have seen when the economies mature. So credit penetration has just started taking off. Turnaround times have collapsed between time taken for a loan evaluation to a loan sanction, and which is why we've seen consumer durable finance actually evolve into a large category, specifically in the last 5 years. So as data explodes, as we see penetration move up, we would see categories like retail finance, insurance, and allied segments actually see multi-years of growth. So we remain structurally positive on finance as a category within the overall economy. And infra, like what I said, is again going to be a place where one needs to keep his ears to the ground to see when these opportunities play out, rather than trying to see how they will play out. There is enough visibility for, in terms of structure of, which are the areas where it's going to play out. So the key call is to see when they would start playing out in terms of the economic impact.
We have one last question for you, Mr. Bharath. And this is from Krish Reddy. He asked, how Reliance Gigafiber's first day, first show offering going to impact the multiplex business? And are you seeing this as good opportunity?
Okay, so this is a very company-specific question, which you would refrain in terms of giving our house views on a specific company. But nevertheless, just on that space, we've seen, if you were to draw parallels with global markets, as more and more data penetration happens, we've seen the consumers actually start spending more time in terms of entertainment as an activity. So movie watching today is not merely watching movies, but it's about having an experience within a multiplex space. So I think the consumer experience has gone for a drastic change ever since we've seen the penetration of multiplexes move up. And if one has to draw parallel to other economies, I think in terms of data and in terms of having the first day, first show through online, actually is an enabler for people to start increasing the allocation of pool of either resources of either time or the overall wallet share into a category like multiplexes. So it's not been a deterrent if one has to look at some of the other economies, be it the US markets as a proxy. And again, over here, we as a country, we have the largest number of movie releases, even when we compare ourselves to US as a market. So we do more than 2,000 releases in a year, and we have the lowest per capita in terms of the penetration of movie screens. So we have hardly 7 screens per million population compared to a Chinese market, for example, where we have close to 56 screen per million population as a comparable metric. So penetration of multiplexes is still far too lower on one hand. On the other hand, data has always been an enabler if one draws parallels with other economies. So I think on a broad basis, we still think it's going to be a constructive journey for multiplexes as an asset class, if one had to see such events play out in the coming years.
Thank you, Mr. Bharath, for all your views.
Thanks a lot, and happy investing.
Could you give us your closing comments?
Okay. So from the Sundaram Equity Fund, I would like again to reiterate the fact that it's going to be a journey for investors where they're going to be exposed to multiple set of cap curves and with the flexibility to move between large, mid, and small. And the endeavor here is to again provide a risk reward with moderate amount of volatility, and have the investor experience a positive return experience by being with us in this journey. So thanks a lot and happy investing.
Thank you.
Thank you.
Thank you for joining us. I hope you had a very insightful session. If you have more questions, please get in touch with your fund advisor right away. Thank you for joining and happy investing.